When you talk to other investors, you've got to always be on top of people. You can't just assume that like we did this deal together, so they're always going to think of me every time, because they're talking to like 50 other people, and so you've always got to be top of mind, and you've always got to be like cycling in of like how to be top of mind.
Welcome to VC Uncovered, the series where we highlight the next generation of investors who move faster, take bigger risks, and build shoulder to shoulder with founders. I'm your host, Drew Glover, co-founder of Fiat Growth and general partner at Fiat Ventures. Today, I'm sitting down with Xan Wood, investor at Campus Prime, a firm helping early-stage companies in fintech, digital health, and AI push through the critical Series A and B milestones. Xan, thank you so much for coming.
Thanks for having me.
I'm so glad you're here. I feel like I've known you in the space for a long time, and get to see you at different events, get to see you work in the room. You're one of the consummate like networkers, like truly like putting yourself out there. So super thrilled to have you.
I just say yes to everything you asked me to do.
I mean, at this point, when people start saying yes, I start asking them more and more and more. So I'm just waiting for them to say no. So I appreciate you not breaking the trend so far.
Nice.
Cool. During the newsletter process and kind of just really unearthing a lot of the things that you touch on and lean into when it comes to venture, one of the topics that I thought was most fascinating was your idea of being long-term greedy. And as an investor myself, when I hear that, I think, yes, yes, yes. I haven't said it in my brain before, but I think yes, yes, yes. Mm-hmm. But I'm so curious, how do you think about that? Can you break that concept down a little bit more for founders out there, other VCs out there that are just trying to learn?
Yeah, I think the kind of one of the ways I think about it is like doing things without expecting stuff in return in a way can be like a selfish thing, because like you keep on, so like when I first got to the US, I raised like a small fund, like $1 million, and I was finding deal flow and I was sending them to like seed investors. And like, obviously when you're $1 million fund, no one sends you deals, but I was sending them out, and like you send deals out to everyone. And then I was kind of thinking like, if you provide enough value for people, eventually they're going to be like, oh wow, like that guy's given me a lot of stuff over time, and so like I kind of owe him now. And so like in a way it's like a long-term thing, do you know what I mean, where it's like instead of being transactional, you're and I think Silicon Valley is like a perfect place for this, where like everyone is giving stuff and not really expecting things in return. And then over time you're in the ecosystem for however many years, and suddenly like you're in the ecosystem even more, you're kind of connected to all these different nodes, and people are like, oh, that person did a nice thing for me. Yep. And so then you're like, they'll be willing to do a nice thing back for you. And so that's like one way of thinking about it, where like, you're just like, okay, I'm just always gonna say yes and try to be helpful to people and not really expect anything back. I think over the long term, that hopefully compounds, basically.
Yes.
And I think long-term greedy is basically a compounding function, where if you let things compound over a very long period of time, I think it's Warren Buffett. It's like the eighth wonder of the world is compounding, and if you get that, you're gonna end up hopefully in a good place.
No, yeah, I love that, and I think one thing a lot of people don't really realize, people that aren't in the venture space, is that like a traditional venture fund is a 10-year fund. Mm-hmm. So the quicker you accept this kind of long-term greedy concept and match that up to the fact that you gotta be in this thing for 10 years regardless. You have to be thinking 10 years out. You got to be thinking 15 years out in some of these different markets where it just takes a little bit longer to get a company some type of liquidity event. But especially in this early stage space, like you need to share, right? And you need to be able to think about sharing without expecting anything back, which for a lot of people is the hardest thing on earth. It's like,
exactly.
I've been passing you, please, where's my
thing back?
Yeah.
And it's the same with like an early stage founder, like, we see a ton of companies we can't invest in.
Yes.
But you also know a ton of people who might be able to invest. And so like, just being like, hey, as long as like, I'm like, hey, Fiat does a lot of stuff in fintech, a lot of go-to-market stuff. Maybe they'll find this interesting. As long as it's like directionally interesting, I talk to a founder, I'd be like, hey, you should talk to the Fiat guys.
Yes.
Maybe, and that way, like that founder's business might not be a fit, but then their next business might be a fit, and maybe they remember you.
No doubt in my mind that since you raising that $1 million fund, your network has just continued to compound, and it's much larger now. This might be getting in the nitty gritty a bit, but how are you organizing your network So when you are sending these intros to a fiat or to these other emerging managers, or even like some of the later stage funds, how are you managing that process to make it so that the output is as valuable as possible?
What's interesting is like, if someone like post something on LinkedIn or something, then you're like, then they remind you
Top of mind.
top of mind.
Yes.
So then I think that's the other thing is like, how do you be top of mind? But then I have like an Airtable where I kind of put the funds, what kind of companies I send them, and then like how, successful that is. But I think like, so that's one thing, but I think it's really hard to keep track of this stuff. And so like for you as like an investor, staying top of mind is like the most important thing, because you've got to, it's like when you talk to other investors, you've got to always be on top of people. You can't just assume that like, we did this deal together, so they're always going to think of me every time. Because they're talking to like 50 other people. And so you've always got to be top of mind, and you've always got to be like cycling in of like how to be top of mind.
You got to be top of mind. And it's funny, like we're keeping score, but not expecting anything in return of what we send them. But they're also keeping score of what you've sent them. And if what you're sending them isn't great, then they're like, oh, I'm not responding to this next one.
Exactly. So it's like a balance.
Yeah, it's a balance, and it's funny because you have to be a VC and invest in the right companies, but you have to be a VC with other VCs and make sure that you're providing value to them. So super fascinating. And then as you think about just like what VC is today, I inherently believe that there's like a shift happening right now of like, you can't just be capital, you have to be so much more than capital, both to other VCs, but also to founders. In this world of AI right now, in terms of where everything is headed, things are changing so quickly. We have some VC funds that are just built on the backs of AI. We have other VC funds that are more traditional, that are just optimizing for AI. But I'm feeling a shift in terms of even how some of these companies are going out and fundraising. Some companies that 5 years ago would have been, hey, I'm going to go raise $10 million round, or saying, no, we're going to bootstrap this thing, or we're not going to raise until we get here. But as you look at the space from a macro perspective, are you feeling any shifts right now?
I think there's like a massive shift in like, one is obviously the size of the funds have got a lot bigger.
Yeah.
And then like, I think everyone has kind of internalized that it's a power law business, which obviously it has been. And so what that means is any company that people think is a power law company will get bid up crazy.
Yes.
Like sub 10 million run rate, 500 million valuation, where like everything's got to go right for it. And there will be, some of these will be power law companies. Obviously some won't be.
Yep.
And that creates one side of the market, which is like the big boys game, or like you've got the very capital intensive companies like an OpenAI or an Anthropic, which again is like a big boys game. You need to be multi-billion-dollar AUM. And then you've got like the other side of the market where like, it's one of the hardest times to raise a Series A or Series B, because if you're not going from like, like a top quartile AI company is going from 0 to 5 million in like under 12 months.
Yep.
Where like a top quartile SaaS company in the last era was 0 to 1 million in 12 months. And so like, if you're not in that, you're kind of in like a bit of a death valley, because everyone's willing to like pay up for these expensive companies, but for the like slower growth, like still very good growth companies, people are, at some point there becomes like a great like value in these companies, because you can have a view that like maybe, workflow software with a bit of AI is still very valuable. Do you know what I mean? And you can build these like very good venture scale businesses at like a lower entry price.
Yes.
And so I think there's definitely a bifurcation. A lot of capital is going to the big funds. There's a lot less like Series A, Series B rounds getting done, even though the ones which are getting done at a much higher price. But like, who knows where it turns out? That's why it's fun, because it's always changing, basically.
I know. And so what stages do you invest in?
So we, at Canvas Prime, we do Series A, Series B, we invest $5 to $20 million, mainly digital health, fintech, with a kind of broad overlay of AI. And I think we're really trying to invest in the companies at the inflection point of the go-to-market, where like, hey, the product is working. Product can always get better and better. There's not like a problem. There's always the product can get better, but it's like, how do we really accelerate the go-to-market? And it's like the Series A, Series B is a super interesting time, because there are a ton of seed companies, a ton of seed managers, so many seed rounds have been done. So you see a lot of companies, and then like we less play in these like crazy rounds because like unless you really believe it's like a generational founder, generational business, then you should pay up. But like I think there's a few which probably get done which might not be that, and like so we're a little bit more in like this kind of traditional venture, and then we do very concentrated portfolios. So we're investing out of a 350 million fund at the moment, where we're trying to do like 20 deals. So very concentrated in our founders.
And do you guys have a ownership percentage you're trying to?
Not really. Like, actually, what I find funny is the ownership point, because like ownership is just another way of saying valuation, isn't it? But like,
totally.
And, like everyone talks about ownership percentages, but really what people care about is the valuation. It's like a nice way. It's like a nice way of saying it. But no, typically it's like 10 to 20%. Really, it's like is what we're going for.
Oh, of course, yeah. When we're talking to a founder, it's more of a negotiation topic, right? Of okay, go. How do we bring this valuation down?
I typically just say as much as possible.
Yeah, totally. But it's interesting because like where you guys are investing in, call it like where like Fiat Ventures invest. We are a pre-seed and seed fund, and we're looking to get 9 to 10% ownership, 8 to 10% ownership. But we're also on our second fund, and we have a lot of LPs where we're still kind of building our say to do ratio, right? Yeah. We say we can get 8 to 10%, so we have to do that. And I sometimes get jealous of funds like yourself where it's a little bit more in the growth stage where you have the ability of moving that pendulum. And you guys have been in the game a little bit longer and been able to invest a little bit longer and have a different track record where you can say, hey, if there's an outlier, like we're in. Technically, we can do that. But the pressure on our shoulders, if
you get it wrong, it doesn't look good.
Of course, exactly.
If you get it right, no one cares.
We bruise a little bit more than you. So that's super interesting. And then it as it pertains to some of the businesses that you guys are investing in, at least what it sounds like, are not the ones that are these $500 million rounds. You're looking for the diamonds, maybe in like in kind of rougher terrain. How are you unearthing those opportunities today?
So I think it's like like how do like your networking and how does that work? And like I think definitely, when you talk to people like at other funds, spending time looking at their portfolio to like start a conversation, because like a seed fund might invest in like 200 companies, but you need to have a view of like cut up that portfolio, filter it and be like, okay, 100 of these companies have raised less than $15 million. Maybe they're interesting for us. Then you can be like, they're in the US. They've raised in the last 4 years. Like they haven't raised, and then you can kind of pull down a 200 portfolio to maybe like 30 or 40. You then talk to someone and you'd be like, hey, is this company interesting? And then it just starts like a conversation directionally, because if you ask someone like, what is your best company? No one really knows at a seed fund because they're in so many companies. So
that's true. Yeah.
So I think that's like one way. I think founders as well are always willing, founders in our companies are always willing to kind of send companies they come across.
That's great.
I run a weekly newsletter, which is focused more on Berkeley network, which has quite a lot of subscribers. And so I get quite a lot of companies kind of through that network in Berkeley. And so,
go Bears, by the way.
Go Bears, exactly. Go Bears. And then, so it's just different. And it's just like anywhere. Do you know what I mean? You've got to be everywhere. And like, there's always, like, I think when you say like, there's so many reasons why a company can struggle to fundraise. It can be like, the partner they worked with at a fund has moved on. It can be like the sector, fintech last year was like hard to fundraise. And now, fintech is very hot again. Everyone's doing deals there. So maybe it's just like a sector thing. Maybe it's just like someone's not that well connected in the ecosystem. So it's just like how there are so many reasons. And then so the key is like not why maybe the fundraisers, and it's like, why is the founder and the team and the business the right place to invest?
So I want to go back for a second and just talk a little bit more about the newsletter you run. Because one thing that I've seen, I'd say over the last couple of years here, is a lot of VCs kind of building their own social presence, content strategy, and it really being individual based, but it giving you a leg up in terms of being able to network, in terms of being able to, I think, really organize your general network really well, but also at the same time, you get to stay top of people's inbox. And I think that's really, really important in where we kind of sit today, of being more than just you and an email account constantly trying to like text and email people. So how has that added value to you as an individual, being able to have that community and scale it?
Yeah, so I think like first off, the format of the newsletter is basically every week, which again is a labor of love to do these things weekly.
Oh, it's a grind.
Is you have all companies with a Berkeley founder are like they announce their rounds are announced. So it's like, and what's amazing is each week out of Berkeley, it's like $100 to $1 billion is raised, pretty standard, and that is like that's like the typical content. And then I put.
Wait, you say every week, every month?
Every week.
Wow.
It's like and so like I started this about a year and a half ago, and it's something like 80 billion has been raised by Berkeley founders, which is
Go Bears.
Go Bears, go Bears, which is insane. And then so there's that, and then like initially I just did that, and then I was like, okay, maybe I should like start doing some content, and so then I just put like my thought of the week, and so like this week I spoke about like what I think is happening in pricing in like certain like AI magic features.
Yeah.
And then it's just like a tiny little blurb. And like every time I see someone who's like on the newsletter, they're like, that's quite a nice, like, and it's like, that takes a little bit of time, but it's like, again, it's staying top of mind. And then it's like, you know, if there's like a Berkeley founder, I can be like, talk to them and be like, do you know what I mean? It's like a way to get
organic.
in. It's organic and it's a way to get in. So that's great. It's like it's like a very niche newsletter. So, but like it's like a niche newsletter in like a target-rich environment.
Yeah.
Out of Canvas, we backed a ton of Berkeley founders, and so it's like a very good, and it's like a unique way of A, being top of mind, B, getting deals, maybe winning deals, and all of that stuff. So that's all helpful.
I love that. I'm super bullish on niche communities. Like even what we do with VC Uncovered, like it's very niche.
Exactly.
It's a very specific type of VC. And we want to make sure we get the operators that are also investing. But the thing is a lot of folks, I think, with newsletters are saying, how do I get 200,000, 300,000, 400,000 followers? I would argue that having, anywhere from 500 to a couple thousand of like the best of the best drives so much more long-term value in terms of the community that you're building.
Yeah. And so like for that newsletter, we've got 5,000 subscribers.
That's great.
And it's like a 65% open rate, which is like high for this industry.
Huge.
And so like that is because everyone is like, they're like very target rich.
Yeah.
I'm like, maybe we could get the whole 200,000 Berkeley alumni. So that'd be nice one day.
That's awesome. I mean, that is such a high open rate. And do you have any like cool stories of like what has come organically from the newsletter to date?
I think I get like, you just get a lot of nice people reach out to chat.
Yeah.
Do you know what I mean? Where a lot of people will just like send, like nice messages and all this stuff, and like companies get through. I actually had my first event where I was media last week, and then again, it's like exposure. I did a post, which I kind of copied from the newsletter, and like 200,000 people see it on LinkedIn because it's like, the chancellor is sharing it and all this stuff. And so, all of that is just nice. Do you know what I mean? And so again, it's long term. It's like, and it's painful because it's like every week you got to do this.
Of course, yeah.
So I'm kind of like, if I do it, if you keep on doing it for like even 5-10 years, it's like an institution.
Yeah. That's right.
And then everyone is like that. Do you know what I mean?
And you just have to like underwrite your time a bit. Like, okay, if I went to go spend 4 hours at two industry events, or 4 hours just slaving away at this thing that hundreds of thousands of people might see, the trade-off's pretty obvious.
It's a pretty good trade-off.
Yeah, the trade-off's pretty obvious. I want to go back to you started your career in the PE space,
yep,
and you transitioned over to VC. How has that transition been? I'm curious, tell me a little bit about what you were focused on in the PE space, but also what you brought over to the VC space with you.
Yeah, so I started my career in Asia, out in Hong Kong, in private equity. And like what we were doing in that stage was like emerging market. And so it was a mixture of buying businesses. So we bought like a logistics business up in Mongolia, or starting businesses. So we started what became like the largest motorcycle leasing business in Myanmar. And like emerging market investing, I would say, is a lot more similar to like venture capital in the US, where like initially when I came to the US, I was like, I'll get into private equity. It'll be like kind of what I did in Asia. But actually you get into like private equity in the US is much more like financial engineering, spreadsheet driven, like great business, can be a lot of fun. But then I realized like actually like private equity in Asia is like way more, it's the people, where every business is the people, but like it's obviously more weighted to the people.
Yes.
I like to think things are always going wrong in emerging markets. Things are always going wrong in early stage companies. It's just different problems. Do you know what I mean? Where like in like America, it could be the big customer who was a pilot decided not to do it. In like Asia, it'll be like the Dalai Lama has visited Mongolia, China has shut the border. Do you know what I mean? It's like a different problem, but but you still got to work through the problem. So it's just like a problem solving thing.
Yes.
And then I think the third thing, which is there's like an asymmetric information part where, you know, in VC, in early stage, you never get a complete information picture on a company. You know, it's like you need to reference the founder. You need to understand like the quality of the revenue, but it's not like an audited statement, which so it's like, how do you pick different mosaic of a business to kind of come to a conclusion on it, which is the same in the emerging markets as well, where like you're never getting a full transparent information profile on a company. You've got to like really dig down. And so that's kind of what got me excited for the VC in America.
And I hear you keep using the word mosaic, and I know you have a mosaic theory that you really lean into as you just think about the space. Can you explain that?
So like I think if you talk to enough people about a company, you're going to hear a lot of stuff, some of it good, some of it bad, some of it like unsaid. And so you need to be like, why, like if you're talking to a potential customer, maybe they're like, oh, I don't need this product now. But then you're like, okay, but then they kind of told me that they've got this issue, and so they might not know they need the product yet. But then you're trying to like decipher all the different things and like put them back together, and then like overlay it on the investment and be like, does that all make sense? It's like which is hard, but that's the fun part.
Yeah,
that's really the fun part.
You're putting together the puzzle.
Exactly.
You have a million different pieces. I always think of that show Homeland, where Claire Danes, I'm just going off script now, but Claire Danes is she is a genius investigator working for the CIA, but when she gets enough information, she just starts putting it all in that thing and then just turning it all together.
That would be nice to be heard.
I mean, she had some other challenges in the show. Really good show if you haven't seen Homeland, but that's really cool. Yeah. And I 100% agree, because especially when you get really excited about a company, especially in my stage, right, where it's seed, you got a little bit of information, but not all the information. The only thing about where I sit versus where you sit is at a certain point, we need to feel comfortable with what we don't know.
Yep.
Where you guys probably still run into that sometimes, but a little bit less.
A little bit less.
A little bit less. And that just goes back to that power law thing is, you know, what makes me a little crazy is what I don't know, I have to attach back. Like, do I believe that they can hit this multi-billion-dollar vision?
But it's so easy. The thing in venture is it's so easy to say no. And it's like so easy to get like, what's it called? Like, not like jaded. You talk to like 20 companies and you're like, you keep on saying no. And then it's like, how do you keep the excitement? And you must get this as well. Like, how do you keep the excitement keep on going? Dan, you've got to love that. I think to love venture.
There's a lot of things that I have not been good at in my life that I'm still not good at. Mm-hmm. But there's one thing that I've learned to be so good at now that I got through venture, which is saying no.
Yeah.
And you know, I'd say at Fiat, you know, because we're doing like 50 events a year, we're doing so many different things from a community building standpoint. We're saying no 3,000, sometimes 4,000 times a year. And sometimes that's just based on looking at like the deck in a couple seconds. And sometimes that's after 2 months of deep diligence. But I can only imagine it's very similar. Yeah. How big is the team over at Camp?
So we're 4 investors on the team.
Okay.
And then you have about 850 million of assets and 4 investors. So quite a small team. But yeah, it's the same thing where you like, it's just easy to say no.
Yeah.
And like, but you're saying no to people who've like put a lot of effort into the business, and so you've just got to say no friendly, I think.
And people that you want to maintain a relationship with, that you hope when they land on that thing that you do want to lean in with, that they're coming back to you for it, or at least giving you a look at it. So one part of the newsletter, the VC Uncovered newsletter, there was one story in there about you partnering with a boxing promoter that I really want you to talk more about, because it was one of your forays into the space that we're in today.
Yeah, so I think like that, I'll kind of start at the beginning there. So I went to university in Edinburgh in Scotland. And like university in the UK, I think is a little different to here. People in the US, everyone's like focused on getting like internships and getting on the chain. In the UK, it's a lot more like partying. Everyone's having a good time.
Where are you originally from?
From the UK, from London. And so there was this event every Monday. Everyone would go to the club. It was like a great party, and it was one of those events where people didn't want to go to, but everyone went because everyone went. For some reason, I got kicked out of the event. Like, I still blurry on why. And so like I started a rival club night on that Monday, and that kind of like kicked off. And then so we were doing events, like kind of a few weekly events for like 1,000 people. We were doing these one-off events for like 5,000 people. We had like Kygo come to play.
Oh, cool.
And it was like an amazing business model, because effectively you were getting the club for free because it was midweek where only students would go. You were then getting your kind of promoters would get £1 for every drew they got in. And then so let's say it's dollars. So let's say $10 for every drew.
Yeah.
Drew, because they say drew on the door, they pay $9 instead of 10.
Yep.
You get 1 and I get 8. And that was basically the business model. And so that kind of like became pretty big. And then I was looking at like other things to do within like kind of events. And I saw at another university, someone put on this boxing event where effectively they get students, they train them, and then they put them through like an event. And obviously if you have like 20 students, everyone has at least 20 friends.
Yep.
You know, you're easily going to get like 400 to 600 people. You can charge a lot more. And so I was like, cool, I'll go out and do this. I then went out, found a boxing gym, and like was like getting them to agree to kind of to do the coaching. And then I get a call from this guy, a guy called Bradley Walsh, and like, it was pretty aggressive, the call. And he was like, "What are you doing? Like, you're doing like a boxing event in like my territory and all this stuff." And like, so I Googled him, and he'd been on something called Danny Dyer's Deadliest Men, which is like this show in the UK of like people. So he'd been the head of, in the UK they're called The Firm, and that's like a football hooligan club.
Cool name.
And they go and like beat each other. Like that doesn't even happen so much anymore. So he'd gone to jail for quite a few years. And so I was like, wow, this is pretty scary. And I was like, well, I might as well, because I was like, I really want to do this event. I might as well go meet this guy. And I met him, and actually like it transpired that he was like a pretty changed individual, where he now ran a boxing gym to get like people off the street to go box and like, you know, try and change their lives around.
Yeah.
And so like managed to come to a deal with him where he was like the trainer of these students, and I kind of put on the event. And so we were kind of partners in this. And what's amazing is like that was like a partnership, so the events business, like the kind of club nights I sold as I left university, and I kind of kept on doing just the boxing.
Yeah.
Because it was really easy. It was just like, I'd find the people, they would all go to his gym.
And see, these were students you were finding.
Students who want to box each other, like friends. So it's like you...
and were you building a story around like their hatred for each other or anything like that?
Okay. So it's called Lord of the Rings.
Love it.
It's a good name. And like, and it honestly would sell out, like tickets would be like $100 and would sell out like 500 tickets in like 2 minutes. It was like an amazing thing. And it just kept on going because it was like a partnership of this like very unlikely partnership of like, you know, me like 18 years old, this guy who'd been to jail and was like pretty, you know, he'd had a bit of a checkered past. And so, and he was just like a larger than life character. And then what's even more crazy is, you know, kind of 5 years or so after I left Edinburgh, like I started getting a few messages, and he'd been like gangland executed outside his house in Edinburgh, which in Edinburgh is like crazy.
Yeah.
It's not like, it's like a very, so he'd been shot on his doorstep.
Wow.
And like, it seems that what happened was like, he was just like one of those characters who was just like, always like very chatty, always like, and I think he'd been like shot as like a message to some other gang guy. And it was like a pretty crazy story where this guy had like kind of reformed his life.
Yeah.
And then he'd still like, there were still some people from his previous life, I think, who were like after him, and I think had seen him having some kind of success.
Yeah, of course.
And then he got taken down. So that was like a bit, obviously a big shock. But yeah, it was a pretty lasting, you know, partnership of like, you know, I think it's like, there's a lot of lessons there. It's like, don't judge a book by its cover.
Yeah.
Do you know what I mean? It's like,
tell me the lessons.
Yeah,
Keep going.
Don't judge a book by its cover. Obviously, like a lot of the time, you need to partner with someone who's very good at a specific thing, you know, very good at training. Like I'm never going to be able to train these people to box. And so it's really like, you know, I do think the best partnerships can just be out of these, like, you know, people you wouldn't really expect to partner with, but you can really build super strong partnerships. So that was an interesting one. But like and again, like, you know, you're kind of running around like young guy, not really knowing anything, and all this happens. And so, yeah, it was a fun one.
Dude, yeah, what a fun, intense story with a ton of turns.
Yeah,
but
exactly.
I mean, it sounds like you had that entrepreneur DNA early in your career, and you were just like generally willing to, or better yet, you found comfort in just kind of making sense of chaos. You know, I mean, I know this event world is nuts. Like, make money on it, don't lose money on it, get everybody in place so you're working on it versus in it, and then finding the right partners. And
you need a thick skin, because I've done some events where like you put on an event and like one person turns up and you're like, oh my God, this is like the worst thing ever. And that's nearly better, because then no one knows. The worst is you get like 50 people.
Of course.
It's like you wanted 500, but that's...
And so at what point in post 18-year-old you were you saying, I'd rather invest in businesses versus build my own?
Yeah, I think like obviously with the events, it's like you get to like 23 or whatever. You're 23. The people at the events are still 18. You start to get older.
Oh yeah, for sure.
So then it's like a young man's game. And to be honest, I've always loved investing, and so like always really wanted to be in investing. And so like the events was amazing, like very profitable. It meant that like, you know, you were able to do like crazy things in the summer. Like one summer I got with some friends, we drove London to Mongolia in like $1,000 car, because you've got like you're doing all these like fun adventures, because you've got like the cash flow from that. But like you always wanted to do, you know, I think on the building a business side, or like anything, it's always like let's take the newsletter, which is like a very simple thing. I was like, something needs to be done here, you know. And like you keep on talking about it, and if no one's going to do it, you kind of have to do it eventually.
Of course.
Do you know what I mean? And like, and it's the same with like, you know, when I first arrived at Berkeley, myself and a couple of others, we raised this fund of like $1 million, where like we're like, oh, you know, someone like we know people want to do this, but like, you know, want to invest in something to invest back in Berkeley, and like if you don't do it, someone's not going to, you know what I mean? Like,
of course.
And that's like the entrepreneurial stuff, and I think like that is also helpful to like founders we invest in, is like, because like entrepreneurialism in a way, a lot of it is just hustle.
Yes.
It's just like trying to like always help people, always like you see an opportunity and like that works for this guy, how can I like help them and like connect them? And so I think that's like, entrepreneurialism is good for like an
there's a lot of entrepreneur energy in everything you're talking about. I'm curious if you feel comfortable sharing, how much money did you make from all those events that you did in university?
It's a good amount, but it was like not like massive founder exit stuff, but like a very positive outcomes.
Good. All right. Yeah. It's when you started sharing the numbers, I was like, damn, dude, that probably turned out to be something pretty lucrative. You must have been the guy. You were the guy at university.
Yeah. And actually, it was funny because like, you know, you meet people who are like a couple of years below at the university, like in other stuff, and they're like, oh wow, you were like the events guy. Oh my God.
I know, when you're 23, you're like, oh, but when you're 18, you're like, dude, exactly. Let's hang. So cool. You know, as we come to the end here, I do have a couple just like rapid fire ones for you. The first one is, if you could only invest in one industry, what industry would you invest in?
Well, I think, you know, we mainly do financial services, digital health, and so like I think those are the two which are pretty...
Well, let me put it this way. An industry that you aren't currently investing in.
Interesting. I think like, I really do think there's like this, let's say with the AI, it's going to make software become like easier to build, easier to like make. So I think things which is like a intersection of like, maybe off-the-shelf hardware with an AI on top of it, because I think like, you know, that creates a nice switching cost, but you don't have the complication of like building the hardware. Yes. So I think that's super interesting, and but that's not like, maybe I'm copying out because that's not one industry. Do you know what I mean? But like, but that's like an area.
It's a format though. I like that.
It's like you know, where it's like software meets off-the-shelf hardware.
Yeah.
Because like, you know, if you got a camera in a room, maybe it's easy to replace the camera, but like if it's got the software and all that, the switching, it becomes a little bit more of a switching cost than anything else. And so I think like, I've always thought that's just super interesting, where I think a lot of the technology of the hardware has just got better and better, where you kind of know the initial cost, you know the bomb's going to come down, and then if you can put a great software solution on top of it, you can build like super interesting businesses.
Yeah, I love that. us accepting the fact that it's going to keep moving at the pace that it is, do you think they will ultimately help or hurt the VC industry, the investment VC industry?
So like, I think there's two thoughts you want to have in your head. It's like, if you get AGI, like no one's really doing, like what is anyone even doing? Do you know what I mean? And so
Yeah.
you kind of got to invest, assuming that's not going to happen.
Yes.
And so like, I think definitely there'll be the idea where you can build like companies bigger with less people. It's already happening. So I think that's going to happen. But like, again, if you invest, but then if everyone's doing that, at some point you probably need more people to make something happen. And so like, there's like a lot of things which I think remain to be seen.
Yes.
You know, where like there's this idea, like maybe you can build these like very, which I call velociraptors, these like very fast growing companies with very few people.
I love that
But
concept.
like if you know, at some point, maybe you need to add more people in, because like everyone else, like how do you get above the AI?
Yeah,
Do you know what I mean? Which might
exactly.
be people, which who knows? But it
It's
might be
true.
the AI gets good enough that you don't need the people.
Well, that's right. Yeah. And the AI will keep infiltrating like lesser sexy industries. Because obviously the really sexy ones, the AI agents, the different like chatbots, conversational AI, like I get it. But like we're going to HVAC systems now. We're going to like, back of the kitchen technology for chefs, whatever it is. If you
have you seen the new? My favorite thing is the Hoovers. There's like a new robot Hoover out there.
oh, like an iRobot kind of
but
thing.
apparently there's an even better like AI one, which I would love to try.
I'm in market. Yeah. Okay. I'm gonna look that up. If you had a ticket to go anywhere in the world, you and your family go, you have nannies, you have all expenses paid for, and you're at the airport right now, what ticket are you getting? Where are you going?
Japan. It's like the food,
Yes,
just
dude.
the food,
Yes.
the culture.
I agree.
It's just like everything, you know, I just like every meal you have there, whether it's like a 7-Eleven in the train station is tasty. Everything is tasty there.
Yep.
I like the way, it's just such a nice place, Japan,
Love
as in like a place to visit, I think.
Yeah. No, it's amazing. I'm actually going for my 40th birthday next year. I'm very excited.
Where do you go to?
Just me and my wife.
Tokyo or just everywhere around?
We'll go to the majority will be Tokyo, and then we'll typically map out like four or five different places right outside of that. Last question. If you could take one of your superpowers and gift it to the rest of your other investors on your team, what superpower would that be and why?
I think our team is great, but I think what happens in the industry, which I think people are like, I'm just not a big fan of this ghosting, which happens in the industry. I think it's just
I
think it's just mean.
Yes.
It's like a mean thing. And I think it's just mean on people to like, obviously there's stuff is going to slip through the cracks. There's going to be some kind of ghosting, but like, I kind of understand why people ghost, because they always want to have the optionality.
Of course.
Of like
leave the door open.
But like, I kind of think you can, and there's been times where I've like passed on a company and then thought about it for a little bit and then reached out and been like, hey, this is like, I'm still thinking about you and I'd love to chat. And I think the founder is going to be like, that's quite nice. Do you know what I mean?
That kind of transparency is beautiful.
I think it's better. So I think, you know, you get a lot of ghosting. I think the other thing which has happened, not always, but can happen, is you can put people into a company and like get an introduction.
Yes.
Then you see they invest in it, but they don't say anything to you. Like, it's just nice to get an email being like, thanks.
Come on, it's a circle of life.
That is like,
it's a circle of life.
That would be nice.
Bring it back. Bring it back.
So I think that would be that's just like common politeness, I think. But
Love it. Love it.
Those would be the things.
Awesome. Well, Xan Wood, thank you so much for your time. Always a pleasure hanging out with you. Thanks for being so transparent and candid here on this. And I appreciate you, man.
Thanks, man.
Thank you.
Thank you.
This season is supported by Silicon Valley Bank. For decades, Silicon Valley Bank has been a true partner to the innovation economy, helping both founders and funders grow. Silicon Valley Bank, a division of First Citizens Bank, member FDIC. Please note, this podcast is for informational purposes and not investment, financial, or legal advice. The views expressed are those of the speakers and do not necessarily reflect the position of Silicon Valley Bank.